Welcome back to the Book Digest. In today's episode, we are diving into an absolute titan of a book, a true cornerstone of modern finance, Security Analysis by the legendary Benjamin Graham and David Dodd. Now, this book was written almost a century ago, but let me tell you, its lessons are more critical today than ever before.
To really get the power of this book, you have to transport yourself back in time. We're talking 1934. The whole country was still reeling from the great crash of 1929. Wall Street had been a total free-for-all, a casino built on nothing but hype and speculation, and millions of everyday people were financially decimated. It was out of that chaos that a new, more rational way of thinking had to be born.
And who steps into this mess? Two professors from Columbia University, Benjamin Graham and David Dodd. They'd seen the devastation firsthand. They'd even lost money themselves. So they set out to create a logical, principled framework so that a catastrophe like that would never have to happen again. They didn't just write a book, they basically invented the entire discipline of security analysis from the ground up.
So the very first thing they do, and this is maybe the most powerful move in the whole book, is they draw this hard line in the sand. They took two words that Wall Street had kind of mushed together, investment and speculation, and they gave them crystal clear definitions that changed the entire game.
Okay, let's break this down, because every single word here matters. Thorough analysis. That's not a gut feeling or a hot tip from your buddy. It's hard, rigorous work. Safety of principle. That means you've done your homework so well that the chances of a permanent loss of your capital are very, very low. And satisfactory return? That's not about hitting the lottery. It's about getting a reasonable, fair profit for the risk you're taking. Anything else? That's speculating.
And what this all boils down to is a fundamental difference in mindset. You see, the investor on the left thinks like a business owner. They're all about the facts, the figures, the fundamentals. The speculator on the right, they're basically just betting on crowd psychology. They're hoping the price goes up because someone else will be foolish enough to pay more later. It's a night and day difference.
And that leads us right to the intellectual heart of this entire philosophy. If you're not going to just ride the emotional waves of the market, how in the world do you figure out what to pay for a stock? Well, you have to figure out what the business itself is actually worth, totally separate from its crazy up and down stock price. And this brings us to their big idea, intrinsic value. Now, pay close attention to the wording here. Reasonable estimate. This is not some single, magical number that you can pinpoint to the penny. No, it's a calculated range based on cold, hard facts. What does a company own, and how much money does it reliably make? The market price is driven by fear and greed. Intrinsic value is driven by business reality. You see, it's in that gap, that chasm between the market's emotional price and your analytical estimate of its value, that's where the investor finds their golden opportunity. And this one idea leads us directly to Graham's most famous concept for protecting yourself.
And what is that concept? Is probably the most famous phrase in all of value investing, the margin of safety. Think of it like this. It's your seatbelt, your airbag, your fire escape, all rolled into one. It's the buffer that protects you when you're wrong, when bad luck strikes, or when the world just goes crazy.
So how does this work in the real world? It's actually a beautifully simple, disciplined, three-step dance. Step 1, you do the hard work to calculate a conservative estimate of a business's intrinsic value. Step 2, you glance at the price tag the market is slapping on it today. And step 3, the most important part, you only pull the trigger when that price is significantly below your calculated value. That discount, that is your margin of safety.
Okay, so how do you actually do that hard work? How do you calculate that value? Well, Graham and Dodd basically hand you a financial detective's toolkit. And the number one rule of this toolkit? Never, and I mean never, take the reported numbers at face value. You got to learn to read between the lines.
When you're looking at a company's income statement, you have to put on your skeptic's hat. Are those earnings real, cold, hard cash, or are they just some accounting magic? Is the company trying to pass off one lucky year as the new normal? A real analyst is always digging for the economic truth, not just the pretty numbers the company wants you to see. And the balance sheet? Man, that is your ultimate reality check. Just look at this example. Company A's market value is 5 times its physical assets. Its price is all fluff, all hope and dreams about the future. But look at Company B. Whoa, the market says the whole business is worth $100 million, but its tangible assets alone are worth $150 million. You can buy it for less than its liquidation value. That's a powerful floor under your investment. But Graham knew something crucial. You could have all the best spreadsheets and formulas in the world and still fail miserably. Why?
Because the biggest battle you'll ever fight as an investor isn't on a financial statement. It's the one happening between your own two ears. It's all about resisting the madness of the crowd.
This right here gets at the most dangerous belief in all of finance, the new era mentality. It's those four little words that have cost people fortunes over the centuries. This time is different. It's the siren song that fuels every single market bubble, this idea that the old rules of value don't apply anymore because of some shiny new technology. Graham saw it as pure poison.
Now let's be super clear here. Graham wasn't some old curmudgeon who hated growth companies. Not at all. What he hated was overpaying for the promise of growth. Think about it. When you pay a sky-high price today based on a perfect forecast of the distant future, you're leaving yourself with absolutely zero room for error. And guess what? The future is never certain. Your margin of safety vanishes.
So, let's pull all these threads together. At the end of the day, security analysis is so much more than a textbook. It's an enduring, timeless philosophy for making rational decisions in a world that is often completely irrational. It's a mindset.
And that mindset really boils down to this. Do your own homework. Be an analyst, not a blind follower. Always, and I mean always, insist on that margin of safety. Let hard evidence, not your gut feelings, guide your decisions. Be humble and admit that you can't predict the future. And finally, remember that the market is there to serve you, to offer you opportunities, not to tell you what to think.
And that leaves us with one final, very provocative question that really gets to the core of this entire book. When you look at your own decisions, your own actions with your money, which column do you fall into? The book forces you to ask, are you truly an investor or have you just been speculating all along?